Hi, welcome to the Market Alert for Wednesday the 3rd of May 2017. Right, going to do things slightly different this morning because obviously the markets are quiet, and I want to talk about why they're quiet and why you're seeing more black dots on the chart than you would normally. And the answer to that is very, very simple. There is not enough volatility, and when there's not enough volatility, when the implied volatility is below 10 and lower, and the same with the VIX, then the market is quiet. And when it's quiet, the best thing to do is to actually stand aside, and that's the key, one of the keys to successful trading is knowing when not to trade. Most traders are frightened of losing a trade, or missing out on a trade I should say, and it's no big deal because there will always be plenty more trading opportunities. That goes without saying. But what traders are frightened of is missing that big one. It's not being on the one when you've got these low volatilities and then it flips to the big one. Well, when the Dow's trading at 20-odd thousand and you could possibly get, as we did in 2008, over a 60% retracement, it's not a big deal. The key to it is to preserve capital for those times. There's no doubts about it. And at the moment we're sitting in a situation, if you look at this VIX chart here, where you can see when the volatility index has come back to 10 or below, the market has been quiet and then it has exploded, because obviously there's this inverse relationship. When the stock market goes down, the volatility goes up. When the stock market goes up, the volatility goes down. When the stock market goes down and crashes, as in 2005 to 2009, you can see this there, and just to get rid of that one, and then you've got the same thing again. The market comes down as the market goes up as the volatility comes down. Then we have the 2015 1000 point before the market opened on the 24th of August drop, and then you've seen this back down to here. And as it says along the bottom here, as no doubts about it, it says in each case US equities are modestly lower, down 2 to 6% 1 year later, and in 2 of the 3 instances they were down 2 to 6% in 3 months' time. This is what it's saying here, is that when we get into these lows, the months following, the stock market was down between 2 and 6%. But what's interesting is the next bit. Let me just oh no, it's that. More importantly, the following years, which is 1995 to 2008, show remarkable dichotomy of returns up and down 37%, and that's because of these lows that you're seeing there. So again, it's a case of just staying out of the market until the volatility kicks off or improves. And what we're going to see here, and it's not good news either, is we're going to see the volatility become quite dramatic and volatile to trade as well. But that will be initially, and then we'll see the market set up quite nicely for some really good trades. But it always happens. It's the same pattern. It doesn't feel like it's going to come. The market's going to go higher. There are a few things that could stop that at the moment, which I spoke about yesterday, and probably the most important one this week is probably the start of next week, which is going to be the outcome of the French elections. Because we know, if we go back to the daily chart, you will see the gap up from Macron winning the first round. We've covered this before. It's 170 point gap up, and then the market shot up, and now you can see it making its way down, and you've got all of these lower highs. Markets continuing to do this, and there's a bit of weakness today. We have got the FOMC meeting tonight. There's no change on interest rates. They're going to stay at 1% according to the forecast here. And then there's the statement. And then of course later on in the week we've got the non-farm payrolls. So we can expect this to remain quiet. And that's why yesterday you saw this situation of we had the one sell signal, we got to the scalp, I sent a note out, and again, stay out, and you'll see the rest of the day we're stuck in a trading range. Also, again, confirmation of what's going on. Institutionals are selling, as it says there, and unfortunately the retail investors can't stop buying. As I said, Trump supporters thinking that his tax reforms and his massive infrastructure spending is going to make a difference. It's not going to make diddly squat. There was also another interesting thing that Trump put out yesterday on Twitter. Let me just find that for you. So here we go. Trump sent out this tweet saying US needs a good shutdown in September to fix this mess. He's referring to the government, but it's a very interesting statement that he's made, and it is a mess, and at least he's acknowledged the fact that it's a mess. What he can do about it remains to be seen. So as I say, this low volatility really is the catalyst for what it's going to become an incredibly volatile time going forward. There's no doubts about that. We've got these lows, and when we get into these lows, as I've always maintained in all of the implied volatility and videos that I've recorded, when the implied volatility, the VIX volatility, when it gets to historic lows, the market is going to make a significant move. And the thing is, you can't rationalize this with when you're sitting watching the market making new highs. You think this is never going to happen, but as night follows day, it always does. Just go back and have a look. It's very difficult. You become conditioned and believe things will not change, but they do. There's no doubts about it. It's always done it since I uncovered this way back in 1994, no matter what the market. Finally, let's have a look at the implied volatility. And here we can see we've got an increase yesterday of 848 from 819, so there seems to be a bit of risk building here now in the markets. And again, you can see that we've got all of these lows in the market there, but there's nothing to stop that having a shoot back up to the all-time high beforehand. The S&P is making new all-time highs, as is the Nasdaq at the moment as well, and we all know what happened to that. Now let me just remind you what happened again if we go back to 2000, when these markets were making these massive moves. So what we've got here is a monthly chart of the Nasdaq, and you can see from 2009 it's just been one direction with pullbacks, just like all of the other stock markets, and then the market has resumed to the upside. But this is what happens when you get bubbles. This is back in 2000, when they said the market would just keep going and going, and you can see exactly what happened. It came right back to where it started. I mean, I could spend hours going through these charts, in particular the Dow, why it should be back at the 2003 levels before the Iraq war, and if I get time I'll do that for you, because it's actually quite fascinating. So again, you've got this massive bubble, and what you've got to remember is that this recovery, in particular in the US, is a bought recovery, i.e. 4 trillion of bonds on the Federal Reserve's balance sheet. This is not genuine economic growth. This is QE money that was pumped out into the banks, credit that was lent. Again, you could go on to the zero hedge and look at yesterday. 45%, I think we looked at it yesterday if I recall, 45% of US salaries is spent on credit card debt, which is on paying debt, and I think it was 27% was the average of credit card payments. So it just gives you an indication of how big this bloodbath is going to be when the whole thing starts to fall apart. And it has to, because all bubbles fall apart, and we know it's going to, because simply the VIX, the implied volatility, is at these record lows, and when we get down to these lows, we know that we're going to see all sorts of problems. It goes without saying. Right, that will do it, otherwise we could be here for hours. And I'll report in later today. Again, FOMC, first hour maybe something. Crude oil inventories out at 3:30 as well. And again, we'll see what happens. But you know, there are times when you just have to say, okay, you know, I'll keep the powder dry, wait for it to kick off, and then you know, you're going to stack the odds in your favour. And the other key to this is this, that you know the short side is going to be the best side when it does kick off. And as I've always said, you've got, you know, the sort of stepping effect on the way up. you know, this sort of staircase they call it, but on the way down it's an elevator. So again, you make your profits quicker as well, but it's just having the patience just to wait for the markets to kick off. And you know, I said to somebody yesterday, one of the best analogies, if you were going to sail a boat and there's no wind, you're not going to get far. You know, it's no good having the sails up and then going out and all you do is go round in circles. And that's you know, what you'll have with losing trades, because the market isn't actually moving. Whereas if you've got a nice steady breeze and the market's moving, then you'll head in the direction you want to go. So it's again, just hopefully this is, you know, highlighted a few areas that just to make you think about what's actually coming and why you're getting what you're getting at the moment. Right, that will do it. As ever, thanks for watching. Any comments or whatever, let me know. And as ever, thanks for watching. See you in the next one.